Welcome to Subramani. I'm going to talk to you about some very old axioms about the equity market. You might be surprised at some of the things and you might be shocked at some of the things, and some of the things you'll say this is fairly obvious, isn't it? So one which is the most obvious, which people don't see, in the long run we will all make money. All you need is patience. I'm saying it very simply, but it doesn't mean that people can do it. For example, the index was 100 in 1979. If you had invested in the index in 1979, just 100 rupees, just 100, it would be the TRI, total return index, is 1,20,866, right? So that is what would have happened. 1200 times your money would have increased. If you had done an SIP, fairly obvious that it would have been much more. Now I know practically it is not going to be possible. It was not possible because the index was calculated, the Sensex was calculated only in 1984 with retrospective effect. But what it means is, in the long run, good companies which are there in the index always will give you good return over a very long period of time. Please understand, this 1,20,000 looks very attractive, but it is over 41 plus 21 plus 23, 44 years of compounding. We are in the year 24, right? So 23 years plus 21 years, that many years of compounding will definitely have an impact. Having said that, in the short run you could get completely killed because you acted in panic. March 2020 there was COVID. It was impossible to think what is going to happen. It is impossible to think clearly. If you had 100 rupees in the market, maybe you had put 70, it had become 100, and now you were saying, let me protect that 30 rupees. Perfectly normal, rational behavior of an animal which was scared. But unfortunately or fortunately, such situations, acting contrarian makes more money. So buying in 2020 March would have made you a lot of money, but for that you should have had cash. You should have been lucky enough to have cash. So all these combinations are important, but yes, in the short run, you could be killed by the market because of some irrational move that you made, not because the market made. Yes, the market can be irrational in the long run and in the short run. I mean, it can be far more irrational than you can ever be liquid, right? So that's important. But in the short run, this will happen. Never in your 30, 40, 50 years of investing will you get an average return year. You will get an average return over 5 years or 6 years, which could mirror, let's say 12% is what you have got from 1979 till today, or you should have got after expenses and taxes. There will be no single year where you have got 12. There will be a year when you have got 24 and a year when you have got 0. So average would be 12. So don't look for average on a particular year or on a particular share. It doesn't happen. Reversion to the mean happens, but we do not know how often. So can a 12% be followed by a 35%, be then followed by a 13%, and then be followed by a minus 14%? Yes, it can happen. Don't think a 12 will be followed by a 0, or a 24 will be followed by a 0, so that the average comes to 12. That doesn't happen. We do not know how often the average will catch up. Maybe once in 4 years, 5 years. But yes, if 5 years, if you see the market booming, 6th year chances are market will do badly. But you could have thought of it that way even in the 4th year or the 5th year. So the market can do very irrational things for very long periods of time, or rather after it happens we will say, oh, it was so logical, obviously this had to happen. Another thing which we don't realize is, when you build a portfolio, let's say you start with 20 companies and 5% each, or 10% in 10 companies, and this is your portfolio. It will happen that over a 50-year period, there will be only some 7 or 8 years in which you get sensationally good returns, and the other times it is less than average, but still on an average over 50 years you would have done well. So you could get your returns clubbed in one or two shares I'm saying out of 10 maybe one does very well, and if you do not rebalance, because you're an individual, you need not rebalance, you're not a fund manager, and if you do not rebalance, there could be a stage when out of the 10 there will be 2 shares which are now making up 60% of your portfolio and the other 7 or 8 are only 40%, right? This is bound to happen. So your returns will be concentrated on some shares, it will be concentrated on some time. If you if you plot the capitals of where, or the not the head office of where the best companies are situated, that could be a cluster, right? So all these things will happen. Don't think average ever works. You will not, the 10 companies in your portfolio will not all go up by 12% or all fall by 12%. That will never happen. 2 or 3 will grow up by 40%, 70%. That is where the temptation to sell the good ones and buy more of the bad ones has to be resisted. So that's very important, because what happens is we say, oh, on an average I should get so much, I've got 70% in one and I've got minus 8% in the other, so let me sell some of the 70 and buy the minus 8. It could be wrong. Maybe you should be selling the minus 8 and buying the 70. I'm not getting any specific advice, but remember that these things will happen. Rakesh Jhunjhunwala also had a very concentrated portfolio at the time of his death. Obviously during his lifetime he must have bought some and sold some and all that, but still you can come down to having an extremely concentrated portfolio. I have an extremely concentrated portfolio simply because I'm not selling some of those shares. Even if I sell, I'll sell 100 shares or 200 shares, which has no impact on the 50,000 shares that I hold, right? So it happens, we do get into a very concentrated kind of a portfolio. Then you start praying that things don't go too wrong. So we've covered the asymmetric upside, asymmetric downside, both can happen. So in my case, what has worked is cutting losses very quickly. If I see that a company is not doing well or it is not going anywhere, then I don't want to lock my money there, but I let my winners run longer. So my winners can run for 30-40 years. I can get into a situation where I've invested too much in the group or in the company. I don't bother about it too much. I don't look at alpha, beta, the standard deviation of the portfolio. I don't look at all those things, right? There is absolutely no denying that, if you hold a company which is doing well and the earnings are increasing, the EPS is increasing, obviously the price will increase. And if the company has a very regular policy of saying we will pay 30% of EPS as dividend, that consistency is also rewarded by increasing PE. So you make maximum money when the company is doing well, company is more predictable, and therefore the PE does well. So your EPS is also growing, your PE will also improve, but largely over a 30-40 year period, PE should not matter. If it's a good company, PE should not matter even if it's a bad company. You've just got stuck, right? You bought it at a very low PE, it can go lower. You bought at a high PE, the share price is continuing to go up because the earnings are catching up. So don't get too carried away by concepts like PE. Also, one more thing which happens is if you are watching the match, the scoreboard doesn't matter. The scoreboard is for people who are watching the match from far away, or they are not even watching, they are only listening to the commentary, so they can't see what is happening. When you can see what is happening, you don't need the scorecard. So for example, when you are investing in companies which are building a good market share, my examples would be, say, Zomato, could be Indigo. Don't look at ROE, ROCE, RONW. They are still work in progress. It won't happen it won't happen overnight, right? Maruti was not considered to be very profitable till it built good market share, and now it is considered to be a darling of the crowds, right? So similarly, your Indigo, Zomato, or any of those companies of that category which don't have any earning, or have a very small earning, or are not profitable enough, or are not building any great value in the balance sheet as of now, please understand that you need patience. Over time, when they build, you will see all these numbers coming and falling in place, and maybe the margins won't go up for the airlines or for the food delivery company, but once they have the market share, their pricing power will definitely go up. So it's very important to understand that valuations of the company is not going to be reflected in the market all that easily. It's going to take time. So if you think valuations are good and the market does not know and you're very confident about your research, you have to buy it and hold for a long period of time. There is nothing which you can do to save that. Constantly there will be something for you to worry about in the market. There is no doubt about that. Market will constantly say, oh, this is wrong, that is wrong, Modi will win, Modi can't win. What happens if Modi is unwell, right? All these questions will always be there. They have always been there, so they never go away, right? In Tamil there is a saying which says it's like trying to take a dip in the ocean after the waves have gone away. The waves just don't go away. You have to learn to surf. If you want to be a good surfer, you have to get into the water with your surfing board and learn. There is nothing else you can do. Almost always we talk about risk which we can see. We don't talk about risk which we can't see. I don't think in December 2019 or January, February of 2020 people were talking about COVID. We had no clue. We were then still worried about interest rates and etc., etc., etc. And then COVID came. The market didn't go down too badly. Then Ukraine war happened. People thought, oh, war will be over in 15 days, 15 months, and nothing has happened. We still don't know who is winning, who is losing. But yes, the war is still going on. We have zero ability to predict what is going to happen. But we don't need to predict. As long as you are in the market, that's good enough. The market might go up, market might go down. You don't have to worry about all those things, especially if you are investing on a regular basis, what mutual funds call the SIP. Also remember that the market has changed a lot. Once upon a time when I was younger, much younger, we always thought that the market is a place where you come and invest. But today there's a huge population which does not come to invest. They come to speculate, but they are there. There may be 99% of the market, if not 99.1 or maybe 95, 97% of the market, and that is a fact, that is the truth, right? There will always be a lot of turnover, a lot of people who think they can buy today, buy in the morning and sell in the evening. There will be somebody who is buying today to sell in maybe 2054, right? So you have full range of people coming and doing something, and that is what makes the market buoyant. That's what is going to make the market with a high standard deviation. What is happening in the economy, is it exactly reflected in the stock market? In a broad sense, yes. In a broad sense, no. Like for example, if people are borrowing money, that's because they have a feel good that, oh, my portfolio is doing so well, I don't want to disturb it, so let me borrow money for 6 months. That's a very positive way of looking at it, saying he's got assets or she's got assets and still they are borrowing for a particular expense, and they know what they are doing. That is not true for everybody else, right? So understanding the market, seeing what you are doing, whether you should leverage and buy more, these are all questions which you have to answer yourself. There is no one single answer available. Also, many people ask, how many shares should I have? What is the good cutoff? These are all questions which you have to evolve. Should you rebalance? I don't rebalance most of the times, and I have no great regrets about not rebalancing. So it's all your pick. Don't look for answers outside. People like us can give you more questions rather than giving you more answers. Thank you.